Look, interest rates are booming, and there's no better way to see that than the mortgage rate market. If you are in the market for a mortgage, you want to watch this video because you may not be aware just how much extra you're going to pay because interest rates are on the rise. It's actually shocking. So we're going to go over that, and then finally we're going to go into some of the areas of the market that actually can thrive in this uncertain high rate environment. All right, let's get smarter. So here we are, we're looking at the interest rate for 30-year mortgages. Now look, this is FactSet data. It goes back from 2010, and here we are right in late September 2022. But look, rates are already at 6.33%. You can see that that's the highest level since 2010. But more importantly, look at where we were late last year. Literally in December of 2021, rates were right around 3%. And now they've shot up to 6.33%, and they're approaching 7%. All right, so clearly mortgage rates are going through the roof, no pun intended. But it's 6.33% when late last year, rates were right around 3%. You might be wondering, what's the big deal with a 3% increase, Luke? I mean, it's only 3%. Well, let me show you why this is a huge number and it has a massive cost on the home buyer over the life of the loan. So let's get smarter together. If you've never seen an amortization chart, you're really going to like this. So let's assume that you're going to buy a house and the sticker price is $450,000, right? You're going to be asked to put down a 20% down payment, and then you're going to be left financing $360,000. Now, look, in this example, I'm only going to be looking at principal and interest, not going to be, accounting for insurance or taxes or anything like that. But watch what happens as interest rates go up. So a couple years ago, you were able to finance a mortgage anywhere from 2 to 3%. Okay, and let's go ahead and use 3% as the example here. Your payment would be $1,517, okay? Now here's what's interesting. You'll notice that the lower the interest rate, the quicker it takes before your first payment has principal that is more than interest, okay? And look, as you're paying down a loan, you want to be paying down that principal as fast as you can. Well, at 2%, it happens on the first month. At 3%, it takes 84 months, okay? So just keep that in mind as we keep going. Now, after 15 years, right, so halfway through the loan, your balance is roughly $220,000. So that basically means that at 3%, you've got about $140,000 in equity in the house. Also, I think it's interesting to point out that the total that you're going to spend for this loan of $360,000 is just about $546,000. Now, let's compare that to 7%, right? Which I think that's what you can get pretty soon in this market. Well, you'll see that your monthly payment jumps to almost $2,400. So it's almost like a $900 increase. But get this, your first payment where the principal is above interest takes 242 months. So basically, the higher the interest rate, the more you're paying in interest up front. And what does it do with the wealth creation effect? Well, look at this. 15 years later, your balance is $266,000. So you don't even have $100,000 worth of home equity after 15 years if you compare the 3%. More importantly, look at how much you're going to be spending over 30 years, $862,000. This is on your $360,000 mortgage. Now look, for some of the older people that have been around, this is before my time, people were talking about having interest rates in the teens. So let's just look at that. Let's imagine you had a 14% interest rate. All right, well, we know that your payment is going to go to $4,265. It's going to take 302 months before your first payment has more principal than interest. Okay? Keep in mind that 30 years of payments is 360 months. It's going to take 302 at 14% interest rate. But get this, after 15 years, right, you've got a $360,000 mortgage, your remaining balance is $320,000. So you only have $40,000 in equity. And get this, it's going to cost you over $1.5 million over the life of that loan. Clearly, higher interest rates have a big impact, especially as it relates to a mortgage. I mean, late last year, we saw 3% interest rates. Now it's well over 6 and approaching 7. It has a huge compounding effect over 30 years. It really can kill wealth creation. So if you are a new home buyer, maybe consider putting a little bit more extra down on that principal to pay down that loan a little bit earlier with interest rates where they are. As an investor, you might be wondering, what are the areas that I could be looking at in times where rates are rising? There's a lot of uncertainty. People are worried about recession. Well, think about areas that consumers are going to spend regardless of what the economy is doing. The first place would be utilities, right? It's one of the last areas that we're going to cut. We do want to keep our lights on at all times. Additionally, think about healthcare. Very, very defensive, right? No matter what the economy does, we're going to probably try and take care of our health. Additionally, think about staples. Some of these are food products, household items that we really can't live without. A lot of it is food, right? We got to eat. And then lastly, I think you want to have a little bit of energy exposure, right? We know that there's a war over in Russia and Ukraine. That is causing all types of supply constraints. Additionally, it looks like we're probably going to be having higher oil and gas prices for some time. So I think that's an area to also have in your portfolio. I hope you guys learned something today in this video. Let me know. I know it had a little bit of personal finance in there. If you want more videos like this, drop me a line and don't forget to like and subscribe. I'll see you guys next time.